Welcome back to Investing Talk podcast. Today we're focusing on ROST stores. You've provided a really interesting collection of information, and our goal here is to extract the key insights about this off-price retailer.
Understand what makes their business tick.
Exactly. We'll look at their recent performance, their plans for expansion, financials.
And what it all might suggest for someone following the market.
Right. Let's get into it.
Okay, so ROST stores, they operate primarily through two main store formats.
ROST, Rest for Less, and Deeds discounts.
Correct. And their fundamental approach, it's all about offering brand name stuff at pretty big discounts. Think 20% to 60% below what you'd normally pay.
How do they manage that?
It comes down to buying strategy. They purchase excess inventory, basically, finding those deals from manufacturers or other retailers and passing the value on.
That seems like a smart model, sort of capitalizing on mismatches in the wider retail supply chain.
It really is. And it's interesting how they use those two different store brands.
Suggests deliberate targeting, maybe?
Oh, definitely. That's a key point. ROST Dress for Less, that's aimed more towards middle-income consumers, lots of apparel, home goods.
Accessories, that kind of thing.
Right. Whereas DD's discounts, that caters more to the lower-income demographic. The discounts might be even steeper, maybe a different product mix.
So a dual approach to capture a wider slice of that value-focused market.
That's the idea. Cast a wider net.
Okay, that gives us a solid foundation. Now, what's been happening with ROST stores recently? It looks like they've been pretty active with expansion.
Absolutely. Very active. Just in March 2025, they opened 19 new locations.
19 in 1 month.
Well, announced in March, it was 16 ROST stores and 3 ED's discounts spread across, I think, 14 states.
Okay.
And what's really notable is their plan for the rest of fiscal 2025. They're aiming to add approximately 90 new stores in total.
90. Wow.
Yeah, 80 of those being ROST and 10 being DD's. It really signals they're confident, in the off-price model's potential still.
Yeah.
90 new stores is, well, it's a significant commitment. Makes you wonder about the thinking behind it. Why lean so heavily on ROST Dress for Less in that expansion? 80 versus 10.
That's a good question. It could be they see more growth opportunity in that middle-income segment right now.
Or maybe those stores are just performing better?
Could be. Or perhaps it's easier to find the right real estate for the typically larger ROST format. But whatever the reason, these expansion moves are crucial signals about their long-term strategy.
Makes sense. So alongside this big expansion push, how have the financials been looking? The sources pointed to some positive performance, right?
Indeed. Pretty solid. For Q4 of fiscal 2024, they reported EPS of $1.79. Sales were $5.9 billion.
Okay.
And what really stands out is comparable store sales. They were up 3%. Healthy growth there.
And for the full year, fiscal 24.
Full year 24, EPS at $6.32. That was on total sales of $21.1 billion. So, yeah, painting a picture of a company ending that year on strong footing. Those are solid numbers. Now, looking ahead into 2025, one source mentioned their full year results. How did those actually turn out?
Right. For the full fiscal year 2025, revenue landed at $21.1 billion. That's up about 3.7% from fiscal 24.
Okay, steady growth.
But what's maybe more impressive is the net income jumped 12% to $2.09 billion.
12%. Nice.
And the earnings per share for 25 came in at $6.36. Interestingly, that actually beat what analysts were expecting.
Oh, really? By how much?
By about 2%. So it suggests they didn't just grow, they did it more profitably than the street anticipated.
Beating analyst expectations. Always a positive signal for investors. Now, there was also something about a leadership change in finance.
Yes, that's right. On October 1st, 2025, William Sheehan is set to take over as CFO, succeeding Adam Orvos.
And Sheehan, what's his background?
He brings extensive retail experience, really knows the sector. That kind of background can be very valuable as ROST keeps expanding and, navigates the current economic climate.
A seasoned hand at the financial helm during growth and maybe some uncertainty. Makes sense.
A steadying influence, perhaps?
So, expansion and a leadership transition happening. Let's dig a bit deeper into their overall financial health. You mentioned some key metrics beyond just the top and bottom lines.
Right. Their profit margin, for instance, sits at a pretty robust 9.9%.
That sounds quite healthy for retail, especially off-price.
It is. It shows they're efficient at managing costs while still offering those discounts. And their balance sheet looks solid, too.
That's so.
Their debt-to-equity ratio is actually lower than the industry norm. Suggests a strong financial foundation, less leverage risk compared to some peers.
Okay, good margin, manageable debt, reassuring signs of stability.
These are the kinds of metrics that give you a better sense of the underlying financial strength.
And it seems analysts are also forecasting more growth ahead.
They are. The projection is for ROST stores to grow revenue at about a 5.3% annual rate over the next 3 years.
5.3%, how does that compare?
Well, what's interesting is that's actually faster than the forecast for the broader specialty retail industry, which is pegged at 5.0%.
So, outpacing their sector.
Seems to be the expectation. Plus, remember that EPS jump we mentioned, 13.5% from fiscal 24 to 25. That underlines the strong momentum they've had.
Growing faster than the industry average. That's a significant point. Okay, let's shift gears a bit. How has the market reacted? The stock performance. I noticed some slightly conflicting info in the sources.
You're right, there was a bit of divergence. One source noted a recent dip about 1.4%, bringing the price to $135.96.
Okay.
But another source dated early April 2025 mentioned a rise of around 3.7% over the previous week.
So short-term noise.
It really highlights how dynamic stock prices are. They fluctuate based on earnings, market sentiment, news. Short-term moves can definitely paint a mixed picture sometimes.
Understood. So stepping back from the day-to-day, what's the general feeling among analysts right now, considering everything? Expansion, earnings beats, the leadership change?
Generally, the sentiment seems to lean positive. Analysts seem to like the brand strength and, of course, the aggressive expansion.
What? I sense a but coming.
But there is a note of caution in some forecasts for fiscal 2025. It's mainly tied to concerns about, well, consumer spending potentially softening.
Macroeconomic headwinds.
Exactly. Things like inflation, interest rates, how they might impact shoppers' wallets. So optimism about the company, but caution about the broader environment.
A balanced view. Makes sense. Even with a strong company, the macro environment matters.
Okay, let's zoom out again. The industry context. How does ROST stores fit into this off-price world?
Well, the off-price sector itself generally does well when consumers are looking for value, which is often. For companies like ROST, the key is managing inventory really, really well, being able to snap up deals and turn that merchandise over quickly. Agility is crucial.
Got to keep things fresh on the racks. And who are they up against mainly?
The big ones are TJX companies, TJ Maxx, Marshalls.
Right, home goods too. And also Burlington stores. It's a competitive space. So Ross's strategic expansion, opening those new stores, that's a key way they try to maintain or grow their share against those guys.
Grow the footprint to stay competitive. Got it. Okay, strengths and weaknesses time. Based on everything, what are the clear advantages for Ross?
Strengths. Definitely the strong financial performance we talked about, those good margins, efficient asset use.
And the expansion.
And the aggressive, proactive store expansion, yes, shows a clear growth focus. Suggests a well-managed operation.
And on the flip side, potential concerns or red flags?
One thing flagged in the sources was a potential slowing in the revenue growth rate compared to some peers. Relative growth deceleration.
Something to watch.
And fundamentally, their whole model relies heavily on being able to get that discounted merchandise consistently.
Right, if supply dries up.
Exactly. That reliance introduces a certain vulnerability to shifts in the broader retail market and inventory levels.
Yeah. Those are important points. Slower relative growth, the supply dependency. Okay, looking forward then. What are the main catalysts that could drive things for Ross? And the biggest risks?
Catalysts are pretty clear.
Yeah.
Successfully opening those 90 new stores in fiscal 25 is a big one.
Execution is key there.
Absolutely. And future earnings reports, obviously. They'll show if they can keep up the profitability while expanding.
And the potential bumps in the road. Risks.
Big ones are always economic downturns. If consumer spending really tightens up, especially on non-essentials.
Discretionary spending takes a hit.
Precisely. Supply chain disruptions are another risk if they can't get the goods, or cost spike, it hits margins. And then the broader macro stuff. Inflation, interest rates. They influence everything.
Standard retail risks, but maybe amplified by their specific model.
Could be. These are things all retailers face, but yes, the inventory sourcing adds a layer.
Okay. What about sentiment? Investors, social media buzz. What's the feeling out there?
From what the sources suggest, platforms like X, Reddit, investors there seem generally fairly optimistic.
Why is that?
Mostly because of the store expansion and the perceived loyalty of their customers. People seem to like the brand.
But there's always caution, right?
Oh, yes. You definitely see discussions tempering that optimism with worries about those macroeconomic uncertainties we just talked about.
So focused on profitability, growth targets, but aware of the risks?
Seems to be the general vibe, a mix of company-specific confidence and broader economic awareness.
Got it. Let's get into some of the finer details that came up. Any other interesting due diligence points? Leadership, maybe? Strategy?
One thing worth noting is the CEO, Barbara Rutler. She's been leading since 2014.
Okay, decent tenure.
And her time has seen consistent expansion and improved profitability. Suggests stability, clear direction. Also an interesting point on capital allocation.
Oh.
Ross Stores doesn't really pay a significant dividend.
Focusing on reinvestment instead.
Seems like it. The focus appears to be on share buybacks and plowing money back into the business, especially funding that growth, those new stores.
Makes sense if expansion is the priority. Fits the narrative. And their core advantage in the market, what really sets them apart?
It really boils down to their brand recognition. Ross and Davies are well known, combined with that cost leadership from the off-price model.
The value proposition.
Exactly. Consistently offering discounts draws people in. Industry trends help too, like the ongoing demand for value. But the risks remain. Supply chain, inflation impacting costs and consumers, and of course e-commerce competition keeps growing.
Always a factor. So a strong player in a value-driven sector, but facing those constant pressures. Okay, let's try and pull this all together, connect it to the bigger picture for our listeners.
I think what's really compelling is watching how Ross manages that balancing act, offering deep discounts to customers.
Which they have to do for the model.
Right. While also maintaining healthy profits for the company. The big expansion plan shows they really believe in their model's appeal. But then you have the analyst's caution, reminding us how much external factors the economy really matter. Which brings up a question for, anyone listening who's trying to understand these market dynamics.
Yes.
How do you personally weigh that interplay? The company's strengths versus these outside pressures. What does Ross's situation tell you about broader consumer behavior right now?
Those are definitely the key questions, aren't they? That interaction between strategy and the environment.
So to kind of wrap it up, Ross Stores is a fascinating case study in off-price retail. Clear strengths, financial performance, expansion.
But also facing challenges.
But facing headwinds, too, like keeping revenue growth strong and navigating economic uncertainty. We've seen how looking at different sources gives a richer picture.
Definitely highlights the need for multiple perspectives.
And it leaves us with a big question to ponder. How do companies like Ross Stores need to adapt their strategies? Not just to survive, but to really thrive long-term, given how fast consumer preferences and the economy can change?
That's a great point to consider, thinking about that long-term adaptability. Hopefully, this discussion has given everyone a valuable shortcut to understanding Ross Stores based on the info you shared. If you found this insightful, please do subscribe, like the video, and maybe leave a comment with any questions or other companies you'd like us to look into.
And maybe one final provocative thought to leave you with. Ross depends so much on getting discounted merchandise.
Fundamentally, yes.
So how might major shifts in the broader retail world, maybe how big brands manage their inventory differently in the future, how might that impact Ross's ability to get those deals? And what would that mean for their whole business model down the line?